All right, welcome back to the Halftime Report. I'm Dominic Khouw. Now, earlier this month on ETF Edge, we learned that according to a recent market analysis by ETF Action, roughly 90% of single stock ETFs and leveraged or inverse strategies are owned by retail investors. They've been a favorite of bullish individual investors, and demand for increasingly complex products has skyrocketed. But as volatility spikes, it might be time to reassess potential risks versus rewards. So joining me now for the discussion is Mike Khouw, strategist over at YieldMax, co-founder of Openinterest.Pro. He's also a CNBC contributor. Mike, let's talk about the options derivative side of the general markets vis-a-vis what these ETFs are doing with inverse and leverage type products.
Yeah, I guess the first thing I would say is that there's, a lot of different flavors of these types of ETFs. And as a portion of the overall ETF market, these things still remain quite small. So if you can imagine, there's maybe 150 billion in products like this. That's perhaps 1% just of what the AUM for ETFs in the United States is alone. And the United States ETF market is substantially larger than it is in the rest of the world. Now, I think that the spirit of some of these things is quite good. I mean, what you're trying to do is give strategy access to people, basically democratize strategies for people who don't either have the ability or the time to implement some of these strategies themselves. And some of those, as you point out, include leverage or inverse positions. A lot of the ones that we manage, for example, include options overwriting. But, one of the important things to remember is that, of course, this is a double-edged sword. The power of leverage, which can benefit you when asset prices are rising, when volatility increases, or you start to see big drawdowns in the underlying stocks, those things are going to bite a little bit harder in the levered products typically. And I think this is something that retail investors probably want to be aware of.
And really quickly, before we let you go, for this part of the discussion, Mike, if you take a look at the true transaction costs of implementing some of these types of leveraged or inverse strategies versus using the ETFs themselves and paying the fees, where do the fees stack up?
Well, one way I like to think about it is that some of the strategies, if they're more complicated, those tend to be something that you would see generally in something like a hedge fund, where the fees would actually be much higher. But in some cases, if it's sort of a Delta One product or it's just straight leverage, you ought to keep an eye on the fees for those levered products, just in case they might be creating more of a drag on returns than you are hoping for. But I will say that these things in many cases are strategies that people cannot implement themselves. They just really need to know what they're buying.
All right. We are going to continue this conversation over at etfedge.cnbc.com. Mike is going to be joined by Nate Geraci of Novadius Wealth Management to talk broader ETFs and leverage. So, Scott, we'll send things back over to you.
All right, Domino. Thank you. Dom Khouw.